Hi, friends. Welcome back to another episode of Multifamily Deal Talk. I'm your host, Kevin Parrish. Got a good buddy in here today. Let me read his resume for you. We'll introduce him, and he's brought a cool deal to share. He joined ClearWorth Capital a little over 5 years ago as a vice president of investments. He was responsible for acquisitions as well as investment management. Prior to that, he was an investment analyst and transaction manager with Newmark Knight Frank, previously Apartment Realty Advisors, where he gained valuable experience underwriting over 200 assets and a little over $5.5 billion. And right out of school, Chris worked at JP Morgan, held various positions, and that included development and acquisitions. Chris has a degree in real estate finance from the University of Arkansas. He's a member of the Urban Land Institute, holds a real estate license in the state of Texas. He's married with one kid and one on the way, which is exciting. I'd like to introduce good friend Chris Mendenhall. Chris, welcome to the show.
Thank you for having me, Kevin.
Absolutely.
It's been a while. We obviously crossed paths at Newmark and ARA, so nice to meet in a kind of new life.
Come.
Exactly,
Absolutely, man. On the buy side now.
Yes, yeah.
So, well, I appreciate you being here. As we said, Multifamily Deal Talk. You know, the goal is to interview guys with lots of experience from different sides of the business, whether it's buy or sell, and just talk about deals. Everybody loves to talk about deals.
Agreed.
So, let's jump in if you're cool with that.
Yeah.
So just a first general question, just to get us kicked off, that I ask every guest, and just to get your take. So first question is, why multifamily?
Yeah, great question. You know, I think I jumped into the real estate world back in 2012. And, you know, looking back, I wish I jumped right into the principal side at that time. Right. But multifamily has proven to be a really strong place to be in, especially in Dallas-Fort Worth. And I think most people see that because of the demographics in DFW and the population trends and job growth, which continue to be top tier here in DFW and the state of Texas. So we're bullish for the long run here in Dallas. So we're going to continue to buy and source deals through our relationships.
Well, I typically agree with everyone when I ask them why multifamily, but I definitely agree with you on that one. Yeah. So we're obviously here in North Texas. You know, it's been a great market the last few years, and I think you and I both have the same view. It's going to be good for a long time coming. So
I think the key is also, I should just point out, in this, you know, kind of volatile capital market environment, that the fundamentals haven't changed in Dallas-Fort Worth. There's still people moving here. There's still jobs being created. And incomes are going up, generally speaking. So, you know, we
are a short supply.
Yes.
Supply's behind. Demand is up.
Yeah.
So all that to say, we're excited about multifamily.
Agreed.
in North Texas.
Yeah.
So, which is, you know, why we're here, because we are excited about multifamily. We love hearing about deals. Like, we were just at lunch talking deals. So you ready to talk about a deal?
Let's do it.
Cool, man. Let's jump in. So as you and I discussed, I've created a framework called the SAFE method on how to source, analyze, finance, and exit apartment community investments safely and profitably. So I'm excited to hear about the deal you brought. You're telling me a little about it. Let's just run it through that framework, and starting with how you sourced it. So
perfect. Yeah. So this particular asset I want to talk about is named Axiom Hub 121. It's located up in McKinney, so a high growth pocket of the suburbs of Collin County.
How many units?
It is 286 doors.
Okay.
And this one is actually a development deal that we built from ground up.
Okay.
So, you know, we identified this pocket of land within Craig Ranch, closed on the acquisition and the financing in 2018. And we just knew that general area was going to continue to see population growth and strong job growth, as well as in desirable schools, et cetera.
Okay. So So ground up, wasn't there. Obviously had to see the vision. Developers, and even, guys that do repositioning rehabs, they got to see a vision of, hey, here's what this can be, rents are lagging, et cetera. But even more so development guys, right? You got to know, hey, I can put a property here. It's going to be beautiful. It's going to sing, right? So tell us from a source perspective, how the land came about, and then moving through entitlements, et cetera.
Yeah. So it was a process. We found the land actually through a relationship, and we identified it many years prior, and we actually pursued it for a number of years. And
do you remember how many acres?
I want to say it's about just over about 4.5 to 5.
Okay.
4.5 to 5.
Okay.
So we ended up
a smaller site for
smaller site,
300 units, very dense.
Very dense.
Wow.
It's a wrap style deal,
okay.
With a structured parking garage. And, it's a deal that we felt was just in the path of growth. And we knew that there was a large pipeline coming on in this area, but we said, that's okay. We're willing to battle kind of through this.
And now remind me, it's sat on the freeway, correct?
It's right there. It's highly visible. It's actually right next to where the Byron Nelson is now played. Okay. But it's a really cool piece because it's part of a mixed-use development that has some retail that has since come up. We were actually the first development in there, and then the retail came as we were leasing up. So it was actually great momentum going into our sale. Yeah.
Awesome. So as far as the relationship on the land, was that like a brokerage relationship, or was it, through directly to the principal or somebody else that you guys knew?
Yeah, it was more direct in this particular case.
Perfect.
Yeah.
So anything else as far as the sourcing of just this specific piece of land, the property to add?
I think that it was kind of a basic sourcing process. What really excites me about this deal is as the story continues on, right?
Okay. Bill, that's why we're here, man. Deal talk. So just to put a bow on the source, were you guys looking for development at the time, or did it kind of fall in your lap and you ran some numbers and it just made sense? What was that?
Yeah, at the time we were looking for developments. I was at a shop that didn't do a ton of developments, at the time, but maybe we do a handful every year. And we just knew once that land came about that it's going to be in a prime location that will be, continue to grow over the next 10 years.
Okay, well, we're going to find out how it went.
Yeah, exactly.
Through the end of your story here. Okay, cool. So let's move to the analyze. So tell us again, that's kind of where we were headed, right?
Sure.
Found this land. We're looking for development. Just walk us through why you guys, the analysis of it, even, nuts and bolts, and why you thought this would be a good investment.
Yeah. On this particular deal, this was obviously pre-COVID. So, pre-inflation, and, obviously we can look at kind of slightly after COVID, that time frame, and see where prices went in terms of replacement costs. Mm-hmm. So keep in mind that we built this this massive jump in inflation. So, we were planning on building a 4-story wrap the whole time. We had our land at a favorable basis. I want to say we paid around $20 to the dirt for the land.
Great.
And then, our hard costs came in.
And so just for listeners, just trying to unpack stuff, right?
Sure.
$20 to the dirt, $20 a foot.
Yeah.
Right.
Correct.
So, great.
Yeah. Which feels great in today's world.
Especially in that location.
Agreed.
Goodness, yeah.
Agreed. And as we started layering on all of our construction costs and everything, I think we ended up shaking out around, $170 a door all in, on our cost basis there, or slightly under. And we felt like that is a favorable number relative to where a lot of the multifamily world was trading at for newer construction product. We could see that there's, where our all-in costs will be versus where deals are trading at. We feel like there's a good spread there. And, that kind of went into our overall analysis, as well as the rental market was very hot up there at the time, in terms of occupancies and rent growth.
Sure.
And so, on this particular deal, we were projecting over a 20 IRR. And yeah, that's kind of the full analysis.
So obviously, development's not just, hey, buy it, slap some paint on it, right? This is a process that obviously took you guys time. So what was y'all's at the initial analysis, start to finish being sold, exited,
Sure.
giving your investors a return, what was that timeline?
Yeah. So that was all in roughly a 5-year hold,
Okay.
is kind of where, raise equity all the way through lease up and sale was 5 years. And that's what we had in our pro forma. And we were able to achieve just under that. I believe
great.
our total time frame was about 4 years.
Okay.
On that.
So, and we can jump to that when we get to the exit piece. So tell us, a little bit more about like the entitlement process, the time frame of that. And then, did you guys use a development partner? Was it more in-house? Just unpack it just a little bit.
Yeah, sure. So we, our shop was Seneca at the time, which then evolved into ClearWorth Capital. So it was all in-house.
Great.
And
that helps.
Yeah, exactly. Yeah. And so, there's always a period of entitlements and teeing up everything up and working with architects, et cetera. So, that it was about, let's see, 2018 is when we closed on all of our financing, and we delivered the deal with CO in actually March of 2020, right as COVID was hitting. So, that was the kind of the time frame of entitlements and the development process. And then obviously opening the doors in the heart of COVID was a little bit nerve wracking, but we soon found out that, it was actually a pretty good time to open our doors.
That's great. So, one thing I skipped here, I want to just clarify what type of deal, we say there's 3 kinds of deals: a core, a value add, and opportunistic. Which would you say that this was?
Yeah, definitely. You can scratch off value add. I think some of the guys would say that, it was kind of a core play in the suburbs. And I know it sounds kind of goofy saying, in the suburbs, a core play, but you look at what was going on around, and just down 121, you have Legacy West, where they're building high rises and have high rise office, right? So it's like the city centers continue to move outward, and so a lot of the groups that ended up bidding on the deal were core type buyers.
So I know, and you probably, I know this, but maybe core plus, right? It's not quite core city, but it's a core plus. It's just outside of city center, which I would completely agree with you.
Yeah.
A lot of new developments we say are opportunistic, right? You got to see the vision, you got to understand where you're going. But a lot of those are not necessarily in the location that these are, right? This is, it was pretty well balanced between barriers to entry, et cetera, based on where it is. So just wanted to get your take. So core, I agree. And now so you closed on it 2018, said you got your financing. So that was y'all's analysis. Hey, we're confident, given internal development team, and experience and obviously location, that we can execute on this deal in a 3 to 5 year time horizon. So walk us through how you guys structured the deal, just from a financing perspective.
Sure. So initially we went out and got a construction loan with a local bank here in town. We went ahead with the construction process. Well, I should also say, on the equity piece, we partnered with a local group that we've done many deals with in the past. So we had a good trust with them.
So on the construction loan, just tell us a little about metrics. Ballpark's fine. Rate, leverage, recourse, non-recourse, that kind of stuff.
Yeah. So on the construction loan, let's see, we're kind of shaking out to call it, low 60s loan to cost at, and I think we're floating on that construction loan piece at Wall Street Prime plus, I forget what the exact metric was. Yeah. And I'll let you know that it was actually one of the reasons why I bring up this deal is because we actually ended up refinancing this deal in the middle of our lease up, which is very unique.
It is unique.
And so first let me tell you just about the rest of the capital stack, which is we partnered with a local partner, and they did a sliver of mezzanine equity and then, Class B kind of common equity. So that mezzanine equity, they were charging 12% on, and then the rest of the equity slug was, I think like 10%. So that was kind of our capital stack.
And then what was the final rate on this senior piece before you tell us about the refi?
On the
senior.
Okay. Yeah. So we were floating at Wall Street.
Just going in. Do you remember?
Yeah. I want to say it was like it felt, in the beginning, it was like, I don't know, it was probably around 4 to 5%,
Okay.
roughly. Yeah.
That sounds about right for that time too.
Correct.
Which I would take all day today.
Yes.
So.
Well, yeah, I wish we could rewind.
Yep.
And then, so what was unique about this deal is we actually ended up refinancing into a bridge loan,
Okay.
which is unique. Usually people kind of take this construction piece and then refi into maybe a longer term agency or whatever they, select, whatever their business plan allows for. But this,
so let me stop you because
Okay.
this is important. I want to hear about
Yeah,
this
yeah.
piece, but just a step before, because you had mentioned COVID and
Oh,
lease
yes.
up, opening the doors. So we got it financed. We used construction financing. We had a little mezz piece from our equity partner, and then they backfilled the common.
Yeah.
So then we closed. We're off to the races. We're swinging hammers. We're moving dirt. Fast forward, 18, 24 months. It's early 2020. We're opening doors. We're ready to rock, start leasing up. Then what happens?
Yeah. We were nervous because the world was shutting down. The world was shutting down with COVID.
But y'all started leasing before COVID? Or no?
We got a couple leases. We had like a construction trailer and a little mock-up, right? So it's like, it's hard to sell your product when you're kind of in that state.
Yep.
But what we found out is, look, COVID hit the world and turned the world upside down. And thankfully, our architect, we had a built-in co-working space, for example. So
Awesome.
As an amenity. So I think our product actually really catered to a lot of what people were looking for during COVID, which is, common area, had all the bells and whistles in terms of amenities. I mean, if you're locked up in your house, you want to be able to.
And at the time, if you're working in downtown Dallas or a little more infill, but you live in the suburbs, you're driving in every day. Now you can work from home. Now the suburbs, people are flying to the suburbs.
Exactly.
I say flying. I mean, now they're moving out in droves, right? We had an infill deal that was happening to us as occupancy was staying mid 80s because everybody's moving out of town, right?
Correct.
So I'm sure that boded well for. At first, y'all were nervous. So then what happened?
And then lease up just took off.
Okay.
Lease up took off. I remember at one given period, I think we signed like nearly 40 leases in a month. For example,
going to ask how many per month, man.
Yeah, and
awesome.
And that had to be one of the highest that I've ever seen on
like
a new.
15% or something like that.
Yeah, I mean it was an incredible run, and so finally, we kind of started getting to this point where we're like, okay, fast forward a little bit post COVID, as we all know, rates started going down significantly. We didn't have a long-term horizon on the deal. We pro forma'd 5 years initially. We had 12% accruing on a mezz piece. We had, the rest of our pref
floating rate debt.
Yeah, floating rate debt.
How many years? What was the term on your senior?
Yeah, I think we had 2 years left before we had to make a move, essentially getting through our lease up, right? Okay. But we decided, hey, look, we're 60% occupied right now, and we're still continuing our lease up at a relatively fast pace, but we just went out and went to the bridge market and said, hey, who can take out this senior piece and still return a solid chunk of equity? And we're not even fully leased up yet, do you
remember your occupancy?
It was 60%.
Okay.
So we were 60%, but there was a clear path to.
Y'all were hitting your rents.
Hitting our rents.
Above.
Yes.
Churning, like you said, 40 leases 1 month. So let's just say average 20 a month, and they saw the momentum.
Correct.
Okay.
And so we said, okay, let's just move now because, we're going to have X amount more months of 12% tick-in on our mezz piece. Let's just move now. And so we ended up going through the refi process with a bridge lender.
This is awesome.
Yeah.
Okay. So as far as the financing goes, we had our initial capital stack, and now we've done what we call a recap, right? Okay. Yeah. So now you're moving to a bridge lender. You're about to tell us about that. So tell us what that looks like.
So the bridge lender, the proceeds on our refi quote, it took out our senior debt, our construction loan.
Okay.
It completely paid back all of our mezzanine investors, right? The guys that were charging 12%. And then it even paid back, I don't know, I want to say like 15 to 20% of our next slug of equity, which was charging 12%. So anytime you can lower your overall cost of capital in that sense, it's obviously beneficial to the deal.
So what were the terms? Excuse me. What were the terms on this this bridge loan that you
Yeah.
guys got?
So, I think it was a 3+1+1.
Okay.
Once again, it was a floating rate deal. And if you think about what happened post-COVID, SOFR was, or, LIBOR SOFR at the time was next to nothing.
0, yeah.
And, I think the spread was like in the twos, somewhere in that range,
Okay.
right? So like all in, our rate is like, upper twos.
I was gonna say sub 4, but that's even better.
Yeah,
so.
and so
And then, of course, because you were in lease up, you could pro forma a future value. So they're willing to lend on that future value to back in, which allowed you guys to up your leverage, right? Which then allowed you to take out, up to the mezz piece and a little bit of common equity.
correct.
So did you return the investor capital, or did you guys hold some back in working capital to then finish the project, or was it capitalized enough? How did that look?
That for that piece, we returned all the equity, because we are an IRR driven shop, as time
Yes, sir.
and IRRs are
not our friends. So.
Yeah, exact. Time is not your friend. So
Yep.
you need to return capital in investors' pockets. So we did that. And so through that process, let's see. So now, okay, so the key piece with the bridge and the reason why we went that route is, number one, return money in investors' pockets. And number two, we still, with the floating rate bridge deal, we still have the flexibility of exit, right? And that was the most important piece to us. We were recognizing that this is now mid 2021 when we refied, and we're seeing what's happening with cap rates and rent growth and how things are taking off. So we return capital and we still have the flexibility of exit. That is a very important piece.
You were literally setting the softball on the tee for me here, which I appreciate. So that's a great story. I mean, just on financing, that could be a whole deal talk itself. Right?
Yeah.
So you're moving to the exit already. So I like to say, look, this actually should be backwards, because if you don't know your exit at the beginning, then there's really no reason to invest in a deal, right? So you guys obviously knew what your plan was. The plan shifted a little because the market was shifting. So that's where you were headed. So walk us into that. Obviously, you got new financing, but you wanted the flexibility. I don't think a lot of people talk about that. They either want agency or they want bridge, and they don't quite know what they're going to do.
Yeah.
So why was that important to you guys? Tell us about kind of the exit strategy and ultimately what ended up happening.
I mean, if you think about that time when we refied, summer of 2021, we could have, assuming as if we got leased up fully, a couple months later, we could have put an agency fixed on it for 10 years and just sat on it. And imagine we would be clipping
sub 4. Yeah.
Yeah. It would have been sub 4. It would have, frankly, it's a great strategy if you kind of have that long-term horizon. But for us, we were more, IRR driven in the moment. So,
and you have investors that are,
we have investors,
they
right?
Be long-term guys.
Yeah.
Which is very important to, again, financing, structuring the deal, understanding the alignment of interest, where everybody stands, what they want out of the deal.
Correct.
Right. So,
originally we pro formaed a 5-year hold, and we wanted to stay true to that pro forma number. So that's why we elected the bridge versus the 10-year fix at the time, which, looking back, that would have still been attractive, right? We could have fixed in and we could have spit out quarterly distributions to our investors. But I think a lot of our folks that we worked with at the time wanted to recycle capital and move on to the next deal. So,
well, I think that that speaks to just real estate in general. The power of real estate is having multiple exit strategies. First world problems, at least we call it internally here, is like, well, great, I can refinance it and pull my money out and cash flow, or I could sell it. I've got a huge pop. Let's go do it again, right, in a short period of time. So to me, that's, stars aligning in our business. Seeking alpha, as the guys say. It's like, numerically, it's not alpha, but I'm like, hey, if we have one or two of those options, we're good to go, right? Yeah. So I would say probably was a little market driven, but just knowing a little bit about you guys, it wasn't. Obviously, y'all execute well on y'all's deals that y'all have, and so. So then tell us kind of where it went. Yeah,
sure. So we ended up refining in 2021. Obviously, at that moment, let's see, market rents started really taking off. Our leasing trends, we track a lot of our stuff in Red IQ. So I'll drop a rent roll in Red IQ and you can see recent leasing trends. I think, we were achieving, mid 15% lease turnover, trade outs. So we recognized that it was like, wow, this is like, almost seems a little frothy, I don't know if we can continue this for the long run. In addition to that, rates were still at zero. So, cap rates move in direct correlation with interest rates. And so cap rates were falling like gravity. And we were like, man, maybe we should go out and get a couple BOVs. This was now entering the beginning of 2022.
Okay.
And once again, we had the flexibility of exit.
So you and your team internally as the investment manager are saying, hey, like, we think that there's additional value here that could be squeezed based on what's going on. Probably can't continue. Let's go see what this is worth today.
Sure.
And if that can, lead to the exit strategy.
Exactly.
Right? Okay.
So then, we go out, get the BOVs, a couple of them come back and we're happy with the value. And we say, hey, gosh, I think we need to just take advantage of where we're at, take some chips off the table. I know our investors would be happy with this. Let's go ahead and move. So we ultimately brought it to market, spring of 2022. And now think about what's happening in spring of 22, right? Now rates are starting to change a little bit. Yeah, exactly. Yeah. It's like, it was once again kind of entering a time of unknown.
So before we unpack that,
yeah,
where were the BOVs in relation to your 5-year pro forma value?
Yeah, golly. Our BOVs, I can tell you on a price per door, were anywhere from 280 to up to 300 a door on some BOVs.
And just on a percentage, like where was that?
Sure.
When you guys pro formed it in 2018, hey, here's where I think we can exit.
Yeah.
What percentage higher?
I would call it, I don't know, maybe 120. I mean, it was above our pro forma exit. And frankly, within a slightly shorter time frame, right? So like when we're talking about IRRs, we're significantly above where we pro forma on an IRR basis. So we were like, okay, I think the writing is on the wall here. We're before our total pro forma time frame, and we're higher than what our pro forma exit was. It's time to move.
And then that's because your rents are higher, occupancy is doing what it's supposed to do, the market's going crazy. Like you said, 15% lease trade outs, right?
Yeah.
So okay.
In addition to just cap rate compression at the time, let's be honest, right? We didn't have in our pro forma to exit the deal for a 3.5 cap, right? Like that's so all of that kind of combined together led us to the decision of, I think it's time to move on from this deal and let's put it on the market and see what we can do. Now, at the same time, March of 2022, we put it on the market and things start changing pretty quickly. And so we were kind of racing to get to that.
That's a nice way of saying died.
Yeah. Well, yeah. I mean, it was.
Well, we feel it, right? Like we're one of the first ones because we're an interest rate driven business, right? Within 90 days. I mean, it was crickets, for the most part.
Yeah.
Right. There was a lot of deals in escrow. We were actively selling 2 deals, right? So, but I think from a deal flow acquisition perspective, it was pretty slow. So,
yes.
So continue on that, would love to hear details, obviously, on the sale. I mean, at your discretion, what you want to share, but, finish out this exit piece.
Yeah. I would just say that, we had offers come in on the call for offers date. We're pleased. We put the deal under contract. Ultimately, the buyers performed well. We did deal with a little bit of fluctuation in price, which was kind of normal, quite frankly, at that time. There was a lot of retrades happening. And we ultimately settled on a price. And one last thing I'll say that was unique about the sale was actually the buyer, they ended up assuming our bridge loan.
That is interesting.
Yeah. So that's actually the first time that I have ever heard of that. And I actually, I just asked our bridge lender, I was like, hey guys, look, you guys have a below market spread as to what I can get on new debt today. The proceeds, kind of shake out to the mid 60% range. And would you guys be willing to work with this new group? And they said, yes, we'll just charge, a new, origination fee, et cetera. And
underwrite them,
et cetera. And so that was a very unique deal, which actually helped our buyer kind of get across the finish line. Because debt was kind of hard to come by.
So that's what I was going to ask is what would motivate them from your perspective to want to assume, you obviously had inner workings. They couldn't get the leverage. Was the interest at the time, the interest rate was too high, relative to the price you guys were willing to take, like kind of walk me through
I think the terms of, number one, the proceeds were there. Our spread was lower than market at the time relative to new debt. And then frankly, I think a lot of the bridge lenders at the time were a little bit shaky, kind of in and out of the market. So it kind of left you up to agency being one of the few lenders.
Do you remember how much time was left, the term on the loan?
Yeah, so we sold it 1 year in. So there was still 2 years of term left plus 2 extensions. So, I mean, 4 total years, right? And yeah, ultimately that is what helped the buyer get to the price and close the deal.
Awesome.
Yeah.
Okay, so 4.5 years, soup to nuts. Tell us how it worked out, kind of for you guys.
It was a great result for investors. Obviously, you returned a portion, 3 years in, and then returned the remaining through our refinance, and then returned the remaining after the sale. It ended up being, I want to say, a 2.95 multiple to equity, and I think it shook out to like.
That's not enough, dude. Jeez.
I know. I wish we could do more.
Yeah. Goodness. That's fantastic.
It was a great result. Everyone was happy. And I think it shook out to like, a low 30s, mid to low 30 IRR range. So,
I would say that's definitely higher than some development deals I've seen, but I would be very pleased with that if I had personally invested in a development deal.
Yeah.
So I'm sure your guys were super pleased. So.
They were happy. Development is kind of a strange world where, on a 5-year term, a lot can change in the market, the capital markets, rent growth, rent decline, whatever. A lot can change. And so that's why I think there's a higher risk profile associated with those and higher returns. And in this particular case, it worked out in the investor's favor.
Man, I would say, look, as far as deal talks go, this one's awesome. I mean, it's very unique. There was no deal there. Y'all literally built it and just executed a business plan. So recap, right? So obviously from dirt to construction, built it. The market was getting stronger. You were able to have a recap, get new financing, continue lease up, which was amazing through COVID, right? Obviously, I say amazing loosely. It was just very good. Y'all were very diligent and were able to squeeze some additional value by asset managing really well because you're overseeing it monthly, saying, hey, we're getting really good leasing premiums here relative, right? You said 15%. And then took it to market because you got some really good values. And then even in like that specific, that's a whole nother deal, right? When you say, hey, selling, like that's the second half of this deal, right? So then that's probably a unique deal story. Like you could probably walk through that. Well, most buyers don't assume bridge financing very often. I mean, it's very rare. And the fact that they were able to do that, given the capital markets were at the time tightening and, that loan was better than what they could get is very, very unique. So, dude, that's a deal talk.
Yeah.
I mean,
I
anything
appreciate
to add, put the bow on it. I mean, is that
I think,
kind of wrap it up?
You kind of wrapped
Plus
it
your
up.
returns were, I'd say over and above market, which were really good. So what else?
I think that's kind of it. I mean, I would say that's timing played a lot into that one, and everyone's happy with the result and would love to do it again. And now we're buying value add deals and kind of working within a shorter horizon, but I think that's going to be one to present on our track record that we're really proud of. Yeah.
Put that feather cap.
Yeah.
Hang it on the wall.
Exactly.
Great, man. Well, dude, that's deal talk. I appreciate it.
Great.
Cool. Well, as I was telling you before, I've got a couple just general questions. Get your take on the business here, and then we're going to do something fun. So, okay. So tell me what's one thing that you would change about the multifamily business or industry if you could?
One thing I would change, man, I wish I could, I wish I could kind of tighten up timeframes of closing, I would say, right? Because oftentimes, 60, some contracts are, 60, 90 days.
So are you talking about from a buyer perspective? Or
no. Well, I wish I could make third parties move a little bit faster, and just kind of work within my diligence periods.
I have an appraiser slated to come on the show, so I'll make sure I tell her to
make sure to drop that busy. Because I remember at the height of, maybe post-COVID when tons of transactions were occurring, I was putting deals under contract with 30-day DDs. And there was a period, I think, when I changed my LOI from 30-day DDs to 45, just because it wasn't because of me. It was because
Everybody's
my third parties were so booked.
well, and I would say too, at the time, transaction volume was
Through the
almost
roof.
double
Yeah.
what it has been historically.
Yeah, yeah, yeah.
Right? So,
but that's always kind of a frustrating point is when I reach out to, a PCA group or ESA
Sure.
group and they're booked multiple weeks
Sure.
out, whatever.
I'd say that's fair. And that's
Yeah.
part of our business. Like just clearly your deal talk,
Yeah.
You guys aren't the one necessarily swinging hammers, but you're managing the process. Your company is. So
Yeah.
it's like your company is the one doing the work and swinging hammers. So it's like that is just speaks to our business. It's relational. You've got to be willing to trust that the other guy's going to do what they say. And when deal volume was high, these guys were getting backed up. And now it's like you can't do what you're telling somebody else you can do,
Right.
which maybe makes you look bad. And that's not how our business works, right?
Domino
it's
effect.
performance,
Yeah.
right?
Yeah.
We're in a performance business. Okay. So tightening up timeframes. I like it. So I'll remember that if you ever try to buy a deal from us.
Yeah.
Okay. So second question, what advice would you give to anyone in the business or that wants to get into the business?
Yeah, I would say, start early and dig into the nitty gritty is the advice that I would give. So like some of the stuff that is not necessarily, sexy with multifamily is the operational side. And I would say really try to master the operational side as best as you can because it'll help you in all aspects moving forward. I think so many guys just want to move into kind of the capital markets role or brokerage role, et cetera. But if you don't understand the underlying basics and the operations, then it's it's the best foundation to build from. I would say that.
Amen.
Yeah.
Again, general question. So, but I agree. I think that was when I ended up on the principal side. That was the hardest part to kind of to learn was, wow, this is a lot different than I thought it was going to be.
Yeah.
But if you really dig into it and own it, clearly through y'all's deal talk, it can reap rewards. So very cool.
Yeah.
Okay. Last question. Where do you see the multifamily business heading in the next 1 to 3 years? And second half, 5 to 10 years?
Yeah. Great question. Actually, we kind of spoke about it at lunch. 1 to 3 years. Frankly, I could still see rates being, held steady, call it over the next 1 to 3 years. I think the Fed, the last thing they want to see is inflation creep back up. So I think they're really going to kind of stomp on the neck of the economy, even if they have to do that, just to keep inflation down. But the good news about that in Dallas Fort Worth, we're so lucky to be buying deals in Dallas and Texas as a whole because we still have all the drivers here.
Mm-hmm.
And so like we were talking about at lunch, deals I bought a year ago, yeah, I was subject to buying at cap rates that were, kind of market clearing cap rates last year, which were low relative to today. But I look back at the T12 on those deals I bought, and I'm still achieving my pro forma numbers on the income side, right? So, I think we are just in a great market in Dallas that has the ability to weather storms because of our, just great demographics and job growth and income growth, et cetera.
So I would say in summary, what you're saying is multifamily is going to be good for the next 5 to 10 years. So.
Absolutely. I didn't answer the back half, which
Yeah.
was the 5 to 10 years. And
Yep.
that's the part that I love the most
Yeah.
to think about is like, interest rates, I don't see them staying up forever. I feel like there would be too many things that would break in the economy,
Sure.
right? So like, if we somehow get back to the area that I'm not even saying we have to go back to rates being zero, but somewhere between where we were at 18 months ago and now,
Mm-hmm.
I think we'd be in a really good position as multifamily owners.
So good fundamentals, probably lower interest rates equal being long multifamily.
Agreed.
Got it.
Yeah.
Cool. All right. Time for something fun.
This
is my segment that I like to call buy or sell.
Okay, let's do it.
So 10 just rapid fire, just scenarios or words, and you say buy or sell. Buy being you like it, sell being you don't like it.
Let's do it.
Cool.
Yeah.
Okay. First one, Rivian.
I'll go buy on Rivian. I like
Okay.
Tesla too. Whatever.
Okay.
Yeah.
Cool. Next one, Seinfeld.
Big buy.
Perfect.
Yeah.
I'm a Seinfeld fan myself.
Yeah.
So
Yeah.
Bananas.
Sell. Don't need them.
Yeah. Okay. I agree. I'm gonna sell them bananas too. Okay, let's see. This is the one I set up for you. Bobby Petrino.
Wow. I'll tell you, I was fully bought on him when I was in college. I was there.
Yep.
Yeah. But big sell on him now. Yeah, man. You can't go riding off on your motorcycle with
Well, look, this is why I asked you. I think, being an Aggie, I'm on the buy train now.
I forgot about this. Yeah.
I'm like,
okay.
But that's why I asked you. You were at
Let
Arkansas.
me caveat.
You were Arkansas, so
yes.
Okay.
Yeah. I will say this. Great coach, not the best, outside of business decisions.
I think Jimbo's a little crazy, and so is Petrino, and I'm just curious to see how this goes.
Yeah.
So,
tune in for next year.
Yeah, correct. So, okay. All right. Next, bridge debt.
Historically, we've been a big bridge buyer. Right now, it's kind of a lot of people don't like it. And frankly, we've had a couple experiences recently where, bridge terms kind of change throughout the contract period. So right now I'm selling bridge debt. And I'm
surprised by that. I think y'all are bridge debt guys. So.
Yeah, we are. But I'll tell you,
understand.
A good product that came in to backfill a lot of the bridge space has been local banks doing 3+1+1 with a fixed term over the 3. And I'm still kind of getting to the mid 60s loan to cost. So I'm happy with that.
So is that like a form of bridge debt, but maybe it's a little
exactly.
What's the word? More trustworthy or
more trustworthy, a lot less kind of hooks in the term sheets is what I would say, because
less transactional, more relational.
Yes.
How about that? Yeah.
Agreed. I go sit down with the regional banker at lunch and we have a conversation and we can generally work things out versus a lot of these debt funds are, kind of East Coast sharks,
and
quite frankly.
Business,
and they'll,
So, institutional bridge debt, sell, local bridge debt buy.
There you go.
All right. I've actually been asking our other guests this one: work from home.
I'm a big buyer on that. I do work from home 4 days a week. And I get a ton done when I have a quiet space. I could close my door. When I go into the office, we catch up and to talk. So I'm a buyer.
Okay. That's a good perspective. Income or wage growth?
Wage growth.
Yeah. Are you buying?
Yeah.
Okay.
I'm a buyer.
Growing?
No doubt about it. I see, I get on CoStar. This is one of the main things I track on in my acquisition pipeline. Every deal I look at is I want to see high incomes. And I've seen on some of the deals that I've owned for 3 years on CoStar, I've seen the 1 mile median income grow significantly over the past 3 years. So,
even you would probably agree on site at the property level,
big time. Yeah.
Salaries and wages have been growing.
It affects us and it affects our NOI. It's our third biggest cost after, taxes and insurance. And it kind of hurts our NOI, no doubt about it. But I think there could be there could be some fixes in the future for that. I don't know.
You're buying wage.
I'm buying. Yeah. Sorry.
Okay. A quarter zip.
Interesting. Yeah. I'll rock a quarter zip over the holidays. Okay. Yeah. I'll buy a quarter zip. Yeah.
Great. Yeah. Not right now in the 100.
No.
Right. Yeah. Raisin bread.
Raisin bread. I'm selling raisin bread.
Selling raisin bread.
Yeah. Okay.
Yeah. This is the last one. PGA Live merger.
Oh yeah. Gosh, some people saw it coming. Heck, I just like to watch golf on Sundays. So as long as it's on my TV, I'm buying. Yeah. Okay. Sure.
Awesome. I'm buying that one too.
Yeah, I love that.
That's awesome.
Let the best guys compete.
Well, dude, that has been Buy or Sell and Multifamily Deal Talk, dude. We appreciate you being here. Love that story, man. It's a super unique story.
Yeah.
Tell me how somebody can get a hold of you if they'd like to.
Oh, yeah. So you can contact me.
Just email's probably best.
Yeah. Email is cmendenhall@clearworthcapital.com. And would love to keep in touch with anyone that has any questions or would love to reach out.
Awesome. Cool. Well, we appreciate it. That wraps it up, dude. So
perfect.
Thanks for being here.
Thanks, KP.
Cool. Good to see you.
Yep.
Thanks.